Good afternoon, everyone, or good morning for any new parents that are watching this recording at 4 in the morning. My name is Craig Gingerich. I'm a certified financial planner here at Sage Rutty. For this round of Tele, we're talking about money moves for the new and expecting parents. How exciting is that? It is absolutely a pretty big lift. So the normal 15 minutes, I will try and keep us within that time frame, but I apologize if we run a couple minutes over. As you might imagine, with an earth-shattering change like becoming a parent, there is a lot of information to take in. So let's start with the problem. Welcome to adulthood. I hope you like ibuprofen and not sleeping. Becoming a parent is quite a life-changing situation. For many people, it's the welcoming to adulthood can be quite a wake-up call. And as you might imagine, there's a lot of corresponding money moves that go along with it. So to start out, priority one is just staying in the black. It doesn't matter the direction that your boat is going if you're actively sinking, right? So before we get into some of the fine tuning maneuvers, it's make sure that things are staying afloat. So probably a good idea to go through and review your budget, right? Take another look at things and make sure that it's still working, that you're still going to be operating in the black. Especially you might be seeing post-baby income looking a little different. We'll talk about things like paid family leave or short-term disability. We'll talk about switching to a single income source. That sort of stuff all affects your budget. So don't just look at your budget and say, oh yeah, everything's still fine. Say, okay, well, when we do have a baby, what does that look like? Next, do yourself a favor, automate things. So while your budget may not be changing, your time budget absolutely is going to be changing. Look for ways to automate all of the good behaviors that you can. So automate savings, automate retirement savings, automate bill pay, automate everything that you can. Don't leave it up to chance. Don't leave it up to like, oh, I'll remember it. Well, how well do you function on 2 hours of sleep and remembering things? So automate things, make automation your best friend. And then finally, and I think it goes without saying, give yourself a cushion. Plenty of people say, oh, well, I operate off a very strict budget. Well, babies don't, right? They have their own agenda for things. And so if you are a new parent, you probably already know this. If you're an expecting parent, anticipate you probably need to cushion some of your budgeted expenses. Second, an emergency fund. These are kind of the areas where that drive how much should be in your emergency fund are your expenses, your income, and your risk. Well, your expenses have very likely changed. Your income may have changed, and your risks absolutely have changed. Maybe it's shifting you from a single policy to a family policy for health insurance. That means your deductible just jumped. Risks that just the likelihood that you're going to have an emergency just really goes up dramatically when you add children to the mix. So while you may have been in a spot where it's, okay, I have multiple sources of income coming in the house, my expenses have been really fixed, and I'm relatively low risk, well, then I've erred on the side of 3 months, and my 3 months were only $5,000. Well, when you start adding kids into the mix, it's, well, 3 months expenses might look more like $10,000, and maybe one of the income sources went away. And your risks have gone up. The chances of needing a hospital visit or something like that have gone up. Maybe you need to be shifting from that 3 month of 5,000 closer to a 6 month of 15,000. So take a serious look at your emergency fund and how those three variables have changed within it. Third, life insurance. Life insurance. As a reminder, life insurance is really designed that if you're not around, that your loved ones aren't left destitute, right? For many, life insurance need is actually pretty low while you don't have children, and it tends to change pretty dramatically when you add children to the mix. A lot of people ask, like, how much do I need? I've been meeting with a bunch of prospects, and it seems like it's just been a theme over the last couple months that people are saying, hey, I'm expecting, what do I need to do money-wise? Life insurance is a big piece of that, and figuring out how much you need is a function of three pieces. So it's first what your general spending is. So if you're in a household and your income went away, what are the general expenses going to be, and how much of that do you want to replace? My general rule is about 15 years. Some people say I want to cover my surviving family till age 65 or till the kids are in college or something like that. But looking at general spending, don't forget that there's lost savings in there. So if you're saving 15% of your pay into your 401k and then you're dead, that saving is not happening anymore. So recognize that saving goes out the window. You may need to increase your insurance to cover that. And then most people have expenses they'd like to have covered by that insurance. So if they weren't around, I want to have my mortgage paid off. I want to have the car paid off. I want to do this, that, or the other. I want to have funeral expenses built in there. There's some expenses that you may just want covered. Tack that onto the total insurance need. So how X number of years of general spending, any lost savings, and then tack on specific expenses that you might want covered. Let's talk about the other insurance. Let's talk about health insurance. So health insurance, you may have been a low utilizer of health care before this. Adding children in the mix typically makes you a high utilizer of health care. When you have a child, it becomes what they call a qualifying event, which means there's a 60-day window for you to make changes to your insurance plan. Make sure you add the baby to your insurance plan. I think this goes without saying, but 60 days goes by really, really fast. Make sure you add them. If you have an employer plan, go to your employer ahead of time and say, what paperwork can I fill out so that I can just process it after the child's born? You're now in a spot where there's a high likelihood of hitting your deductible. So if you're in a high deductible plan, you're likely going to hit it. Recognize that in that open enrollment period, if you're changing insurance plans, that's restarting your deductible. So if you have a child in June, well, you may have hit your deductible on your plan up until June, but now going forward, if you've changed insurance plans, you may have a brand new deductible there. Factor that into your calculations. I have plenty of people that say, well, I was on a high deductible plan from January, had a baby in November. Well, for the rest of that calendar year, I opted for a copay plan because if not, every expense that I had would have been just straight out of pocket and a high deductible from starting over. So recognize if you do change plans, it's a restart button, which should play into your decisions. And third, I like to remind people of the trade-off of high deductible versus copay plans. So some employers have shifted to you only offer one or the other. If you're in that spot, then it doesn't make a difference. If your employer is offering both, high deductible plans are less expensive if you're a really low utilizer of healthcare or if you're a really high utilizer of healthcare. In the middle ground, copay math makes sense, but on the low end, it's, hey, I don't have much in the way of expenses. I'll just pay low premiums, and that's great. On the high end, it's I'm paying low premiums, I hit my deductible, and after the deductible, everything is cheap or free. So take a look at those because some people say, if I'm going to be a high utilizer, I just automatically want to go to a copay plan. Generally not true. Generally, it's if you're a high utilizer, a high deductible plan means that you're going to hit your deductible and becomes cheaper after that point. Sorry about that. Estate documents. Now is the time. Similar to insurance, how many people don't need life insurance before they have children, a lot of people put off doing estate documents until they have children. Now is the time. The standard package kind of includes the standard things, so your last will and testament, a living will or a healthcare proxy or both, a power of attorney, and most times we'll review your beneficiaries, which are vitally important. Won't dive into that too much. That's a whole extra seminar for another day. Most important for new or expecting parents, naming guardians. This is why you need your estate documents. Name the guardians for your children or for your children to be. If you want to have a really fun, interesting conversation, if you're married, have the conversation. Think about whose family is going to be named as guardians for the children. That is a pretty interesting little trade-off. As I was prepping for this, I was talking it over with my wife, like when we do have children, who are we going to want to have named? And that adds a fun little variable to things. Obviously, I thought my family, she thought her family, so we won't dive into that one. That's a fun conversation. College savings. So I know that it's kind of a ways down the road if you're an expecting parent or a new parent. But if you want to be saving for college, if you want to be putting money away and letting it compound over the long term, 529 accounts are the best way to go about it. If you're in New York State, you get a New York State tax deduction up to the first 10 grand that you're putting in. And more importantly, all of the growth is tax-free. So if I put in $1,000 and it grows to $3,000, I've avoided paying taxes on 2 grand. That is huge. That is absolutely huge. Don't overlook that. It's like a Roth account, but even better because you get an extra tax deduction on top of it. The most common thing that I'll hear from people, and I was just on a call earlier with a woman asking about 529s. Well, what if my child gets a full ride? Then I'm going to be stuck with this 529 account. And I'm going to be penalized if I use it not for education. If your child does get scholarships, you can either A, shift it to a different child, or B, reimburse yourself from that dollar for dollar up to the scholarship amount. And it's taxable, but it doesn't have that penalty. So it's the same as if you didn't put it under a 529. So they don't penalize you for getting scholarships. All right, this one is a little bit scary. Let's talk about dependent care FSAs. So the average cost of daycare, of childcare for an infant, for a toddler, and for a school-age kid. And I'll pause 1 second while everyone stops to throw up a little bit. Yeah, I'm sorry. If you are currently pregnant and have morning sickness, this was a little rude of me. I probably shouldn't have included it, but this is my reaction to those numbers. That is an absurd amount of expense. So the solution, or not the solution, but to help with the problem, utilizing a dependent care FSA. So this is offered through a lot of different, most employers, or a lot of employers at least. And it's an account, it's a flexible spending account. You're able to put in dollars pre-tax. And not only is it pre-tax of federal and pre-tax of state, but it also avoids Social Security and Medicare. So pretty nice benefit. Importantly, it is a use it or lose it account though. So there's some risk that comes along with that. Recognizing, so if we go back and say, hey, I'm gonna have an infant and $10,000, well, if you're able to put that $10,000 in there and avoid, say, 22% in federal, 6% in state, another 6% in Social Security and Medicare, means you're avoiding 34%. That's $3,400. That's a pretty big savings. So dependent care FSA is absolutely your friend. You have to wait until open enrollment to do it, or a qualifying event like having a child. But that qualifying event only opens the window for 30 days, which is not much time at all. You need to be prepared ahead of time to take advantage of it. So if you're expecting and you're thinking, okay, I'm going to need the dependent care FSA, calculate how many months you're anticipating of dependent care, and then get out ahead of it. Be prepared to file the paperwork as soon as you can, because you may be in a spot where you're still out on maternity or paternity leave while that window is open. If the dependent care FSA is not available, or it doesn't make sense for you, or you're just not interested, there is a child care tax credit. So child care tax credit, we'll talk about child tax credits next, but a child care tax credit that can be used to offset 20 to 35% of what that expense is. And that is something that you would qualify for on your tax return, and any good accountant or tax software will tell you this. Next, child tax credits. So not just the care credit, but credit just for having the child. Normally it's $2,000 per child, and has a phase out limit of $200,000 if you're single, or $400,000 if you're married filing jointly, and head of household looks a little different, and if you're married filing separate, it looks different, but these are the main ones. Just as a reminder, credits are way better than deductions. So $2,000 credit means $2,000 of actual dollars back in your tax return. Pretty nice. In 2021, they've increased that. They've improved it. So in 2021, for any child 17 and under, it's up to $3,000 per child, or $3,600 if they're under age 6. And actually, they're starting to pay this monthly. So it's partially paid in advance monthly from July to December. So this kicks in on July 15th if you have a child and was on your tax return for last year. and you qualify based on the income thresholds of 75,000 or 150,000, you'll begin receiving monthly payments every month from July to December. And then when you file your tax return, you'll get that remaining $2,000. So pretty great, pretty nice benefit. If you have a child, the recent reform has been pretty good to you. Along with the stimulus package, they've also added in extra tax credits. As you might imagine, it gets complicated with phase out limits, and you notice that the 75 and the 150 is different than the 200 and 400. If you're wondering how all of that works, there's a really cool calculator on Kiplinger. Go on there, just Google tax credit calculator Kiplinger, and it will take you here, and it can show you exactly based off of your incomes and your children's and their age, children and their age. It'll show you how much to be expecting monthly and how much to expect on your tax return. All right, recognize we're a minute over, so we'll keep carrying on. I apologize, but let's talk about maternity and paternity leave. As a general rule, ask your company what their policy is a good starting point. Candidly, this is the most complex area and the weakest area for me. So work with your company, work with your HR department on how it works. If you are an expecting mother, recognize that having a child qualifies for short-term disability. If you are an expecting mother and you're required to do bed rest, if your doctor forces you to do bed rest, some policies cover that for short-term disability. So it's on a per policy basis, but you should know. Paid family leave is also an option. So here in New York, there's paid family leave. It's up to 12 weeks that you can qualify for. So up to 12 weeks, it will cover 2/3 of your pay, and it can be used within the first 12 months after birth. So after birth or after the point of adoption. So you can use it for maternity leave, paternity leave, or parental bonding. Recognizing it has to be after receiving the child in whatever matter that is. And then you have 12 months to use it, and you can use up to 12 weeks. It does not have to be consecutive, but it does need to go along with whatever your company's policy is. So look into it, meet with HR because it gets complex, and then start building that into your post-baby budget. All right, let's look at the checklist. What we talked about, I realize it went really quickly. So just as a reminder, there is a summary of everything along with this recording available on the website. So if you're wondering some questions, you can always reach out to me or go to that summary page. So your checklist today, be sure to update your budget. Revisit your emergency fund is an important one. Start looking at life insurance and making sure you're covered enough. Adjust your health insurance and know there's only a 60-day window to do that outside of open enrollment. Get your estate documents or get them updated. If you're looking at college funding, 529 accounts are the right way to go. If you're going to need to have daycare, or it covers also like a nanny, dependent care FSAs can save you serious tax dollars. Your tax credit, if you're wondering what it's going to work out to, you can go to that Kiplinger calculator and type in your information, and it will tell you how much your tax credits are going to be. I also want to point out that the phase outs on that, the phase outs on the tax credit is based off of based off of adjusted gross income. So there are things that reduce your adjusted gross income, like your 401k, like dependent care FSA, like your health savings account. All of those reduce your adjusted gross income. So maybe your normal gross pay looks like 170, but if you're able to throw across those accounts to lower you below the 150, not only does it save you tax dollars, it also means that you might get extra tax credits on top of it. So just something, if you're close to a threshold, maybe reach out and we can have a conversation on whether it makes sense to try and manipulate your income a little bit, use very legal ways to do it, but manipulate your income to generate more tax credits. And then be sure to coordinate with your HR before going out on leave. If you only did one thing, this would be the one to do it. Coordinate with HR. That is incredibly important. They'll be your best friend in this process. So finally, good luck out there. Love this quote from Buddy the Elf. I slept great last night, got a full 40 minutes. If you do have questions, if you do need some help, I can't change diapers. I won't pick up the phone at 4 a.m., but otherwise I am happy to help. I'm here to help. Take advantage of it. It has my direct office number and my direct email. Please take advantage of it. Happy to help. And I'll finish as always with thank you. So thanks for your time today. Thank you for the business and trust that you're placing with me and with Sage Rutty. I know that there are plenty of other options that are out there, and we do not take it lightly that you continue to choose to work with Sage Rutty. So thank you. Happy to take any questions if you have them. If not, I hope everyone has a wonderful afternoon.